Welcome to Explain the Charts. I am your host, and today is March 16th, 2026. We are looking at a market that is currently being gripped by extreme geopolitical anxiety as the conflict in the Middle East enters its third week. The S&P 500 closed the previous session at 6,632.19, marking its third straight losing week. The primary driver behind this weakness is the surge in crude oil, with Brent crude topping the psychological $100 per barrel mark. This energy shock has caused a domino effect, reigniting inflation fears and causing investors to rapidly scale back their expectations for Federal Reserve interest rate cuts. Wall Street is now weighing the possibility of a severe recession if oil prices remain above $90, with some analysts predicting a drop as low as 5,400 on the index. However, futures are currently showing signs of a small relief bounce this morning as traders look toward upcoming policy decisions. Let's dive into the charts to see how this news correlates with the actual price action we are seeing on the screen. Starting with the daily chart, we can see the long-term bull run that peaked near 7,002 earlier this year. The recent decline from that 52-week high has been sharp, slicing through previous consolidation zones with high volume. Notice the heavy red candles appearing right as the news of military strikes involving Iran first broke in early March. The price is currently hovering around the 6,632 level, which is a significant retreat from the year's start. Technically, we have seen a breakdown from what was previously considered strong horizontal support around 6,800. Analysts are calling this a critical pivot point. Staying below 6,800 keeps the bearish momentum firmly in control. The daily candles show that every time we try to rally, the move is met with selling pressure as oil volatility persists. If the 6,600 level fails to hold as support, the next major downside target sits much lower, potentially toward the 6,000 psychological handle. Switching over to the 1-hour chart, we get a better look at the intraday volatility that has plagued the market recently. Look at the period around February 23rd to February 25th, where we saw a massive shakeup in AI stocks and tech trade uncertainty. The price action here shows a series of lower highs and lower lows, which is the definition of a short-term downtrend. The gap downs are particularly telling, as they represent the market pricing in new geopolitical developments overnight. We see a brief attempt at a comeback on March 9th after signals that the war might end soon, but that rally was quickly sold off. This sell-the-rip behavior suggests that institutional investors are de-risking until there is more clarity on energy costs. Current resistance is now stacked at 6,780 and 6,850 on this hourly time frame. Any sustained move above these levels would be the first sign that the false breakdown theory is playing out. Now, let's zoom in even closer using the 15-minute chart to look at the action from the last few trading days. This time frame highlights the desperation in the market as oil hit its peaks on March 11th and 12th. On March 11th, we saw a massive slide from the 677 level down to 670 within just a few hours. The volume spikes accompanying these drops indicate panic selling among retail traders who are chasing the energy surge. On March 12th, the selling continued, with SPY hitting new lows as the market weighed the GDP data and soft labor signals. The trend on this chart is decidedly bearish, characterized by a lack of buying interest even at these lower valuations. Notice the small consolidation around 662 on Friday the 13th. This is where the market attempted to find a floor. This area around 662 is our immediate support to watch for the start of this week. Back to the daily view, we need to consider both the bullish and bearish scenarios for the coming weeks. The bearish case is heavily reliant on oil remaining above $100, which would force the Fed to stay hawkish despite soft GDP. If we see oil prices escalate further, a 10% to 15% correction from here is not out of the question, targeting that 5,400 zone. On the bullish side, if the conflict in Iran de-escalates, the market is primed for a massive relief rally. Many tech stocks, including Microsoft and Nvidia, are starting to look historically cheap according to some analysts. Utilities and REITs are currently acting as wartime havens, outperforming the broader index as investors seek safety. You should watch the VIX as well. It's currently elevated at 26.49, which usually precedes a significant market turning point. Whether that turn is up or down depends entirely on the headlines coming out of the Middle East tonight. To recap the important price levels, 6,800 is our primary resistance and the line in the sand for a recovery. 6,600 is our immediate support. If this breaks, we could see a fast move towards 6,400 or lower. The 52-week high of 7,002 now feels like a distant memory, but it remains the ultimate goal for the bulls in late 2026. In terms of unbiased predictions, I believe there is a 60% chance of continued volatility and a possible test of 6,400. This likelihood is reinforced by the standstill in the Strait of Hormuz and the persistence of high gasoline costs. However, there is a 40% chance of a sharp reversal if a ceasefire is announced or if the Fed adopts a dovish tone. Keep an eye on the upcoming Consumer Price Index (CPI) data, as it will be the next major catalyst for the Fed's decision. When trading SPY right now, remember that the news is moving the chart more than the technicals alone. Wait for confirmation of a break above resistance or a bounce off support before committing to a large position. Thank you for watching Explain the Charts. Be sure to subscribe for daily updates on the S&P 500 and global markets. This video is for educational purposes only and is not financial advice. Always perform your own research and consult with a professional before making investment decisions.